Have you seen the performance of the stock market recently? If you haven't, go look at it, because Dow Jones has lost 3,000 points in a week. Now that's a sharp decline, and if you haven't seen the news on it, everything is related to coronavirus because everybody's trying to estimate the global impact that it has. I have a previous video over here that actually explains on the businesses that have been closing in China, because China is such a main production line for so many products, so many services. And not only that video, I have also a previous video on coronavirus not being a black swan event. If you're keen to find out, go check out that link over there. But today is all about stock market performance, and some people are saying you should buy the market dips right now. Some people are saying do not catch a falling knife because that's going to burn you money when it comes to investing. So if this topic interests you, continue watching on. Hi guys, welcome back. I'll pause quickly for you to see in this chart over here. In that period of SARS in 2003, in January and February, markets also came down severely. They lost 7% in each of these months. And in previous video, I explained, when markets come down so abruptly, it feels really scary. It's very difficult to be unemotional about prices when they are coming down so drastically. And the next point is what exactly is catching a falling knife? Let me just explain this with this description over here. You see that the main intention for someone that's catching a falling knife is because somebody has invested at $1, and when the prices are coming down, they're just trying to average in to hopefully be able to sell out when the thing rebounds. So there's actually a very gambling kind of a mentality. When prices come down, you try to average down, and hopefully when it comes up, the main concern is when it doesn't go up, you're going to be holding a lot of investments, something that you may not want, at a very bad price, and because things are just going to come down more and more, you start seeing your losses mount up severely. But I'll try to help you dispel what is a real falling knife and what really isn't. If you buy a particular share, that could be a real falling knife. Why? Because take a look at this example, Noble Group. Noble Group is once a big commodity trader, and because of certain scandals, there's a separate topic, its share price actually fell from $6 plus to 6 cents plus. That is such a massive decline. I think that's 99% or something like that. Go look at this chart over here. You realize this company's share price has fallen tremendously, and all this in 3 years, it's lost 99% of its value. That's why if you invest and you hope to just keep buying, averaging down when things come down, you're just going to catch on a lot of shares at wrong prices and you're just going to lose a lot of wealth. So when you buy a particular company, you are actually at risk of catching a falling knife. But if you buy an index, as we know, indexes can never fall to zero. Indexes can never lose 99%, almost impossible. So when you buy an index, you're not really putting yourself at risk of catching a falling knife. Yes, the index can still come down. I show you over here. This is what actually S&P lost in the global financial crisis. It lost more than 50%. Nonetheless, things can rebound because when you're diversified, you're buying broad index, things don't become zero. Things can eventually recover. So that's the main difference, whether it's catching a falling knife or not. Now, next share with you, what exactly does buying the dips actually mean, or how it actually feels? Because when it comes to a real market crash, when prices are falling tremendously on a day-by-day basis, news is going to be bad. So imagine this, you're on an aeroplane, and the aeroplane has some engine fault, and everybody is panicking because the plane might be crashing, or at least it's just going to land abruptly somewhere. Everybody's panicking. When the air stewardess at the start of flight is happily explaining the exit plans, the strategy, nobody's listening, nobody's giving a damn. But when there's real trouble in the aeroplane, everybody's panicking. And by then, it's too late to communicate. It's too late to really think through what exactly are the exit routes, what exactly is the right behavior to prepare. Because everybody in your left and right is just going berserk. So imagine this, when the market comes down, it is the same scenario. Everybody is negative, everybody is selling out. It's very difficult to buy the dips. That's why I suggest for you to lean on the side of buying the dips, and the method to do so is dollar cost averaging. I have a previous video on it, just in case you're new to the concept. Look for that link over there. But in a nutshell, in this Excel sheet, you can quickly see that when you use dollar cost averaging, you're able to lower your costs and get into the market consistently and remove all emotions from the investment process. Now, dollar cost averaging is a recurring process, and it's going to take some time to show effect. And the next question you may have is, how long should you do dollar cost averaging? I'll pause for you to quickly see over here. In this chart, you realize that from the dot-com bubble crash, it took at least 30 months for the market to find the bottom. 30 months. That means 2.5 years. I mean, if you're new to investing, or if you're still thinking how long an investment time frame should be, this quickly dispels the myth that you can go in and out of the market, profit from it quickly, because investment sometimes takes very long to show results. 2.5 years of bad results, subsequently then you see sunshine, subsequently they will see daylight from it. So when it comes to investing, invest long term also. So that's a quick tip. Just in case you're not familiar, look for other videos, other channels on it. I've also put my links below just in case you want one-on-one discussion on dollar cost averaging. I can share with you some principles, some pros and cons with it also. So again, if you have further questions, leave in the comment sections. I'd like to hear from you also. If you haven't subscribed, smash the subscribe button, join our community, become more financially savvy. With that, I'll sign off. Take care and goodbye.